Well, Kelly, they're across the board. The response rates are down across all the surveys that are being done by the government and by private companies. I mean, just to give you a sense of it, if you go back a decade ago, and I think these numbers are mostly right, that about 2/3 of the businesses that were surveyed by the Bureau of Labor Statistics were responding to the survey on employment, the payroll survey. We're now down to less than half of businesses responding, and that's in 10 years. And it fell very sharply during the pandemic. I think a lot of companies just obviously, given the circumstance, stopped reporting and haven't started reporting again. So the response rates are very low. And, the script's still being written here. These response rates continue to decline. And, of course, these are surveys, and you're trying to survey a population, all the employment out there in the country. If the surveys are getting less and less comprehensive, then your ability to gauge what's going on in the economy and the job market in particular is, impaired.
Yeah, and the revisions could get bigger because, like you say, they do benchmark this when they get actual unemployment insurance records, Stephen. It's not just the businesses, it's the population piece of this as well. It could be survey fatigue, privacy, cybersecurity, the pandemic, who knows, right?
Yeah, it's a big issue, and something else I know Mark is aware of is at turning points in the economy, there are expectations for the numbers of businesses that are created and those that go away. And the government has historically not done a terrific job at modeling that at turning points. Makes sense what it does during expansions and during contractions that we know of. But when you have these changes, the birth-death model tends to exaggerate it. So there could be my bigger problem with Mark's argument, though, is that I don't see the weakness in the claims data. And that would be a place it should show up. I don't believe that data, unless I'm mistaken, is affected by the response rate issue. The continuing claims data has been kind of flat. We saw a bit of a surge, hasn't continued to surge. And the weekly inputs in the numbers, as you said at the top of the segment, Kelly, being below 200,000 for 7 weeks now.
Yeah.
It's pretty strong data.
By the way, Steve, did we just get some Fed speak?
Yes. Raphael Bostic from Atlanta saying there's a case to be made that we may need to go higher, we being the Federal Reserve, of course. He is at this point firmly in the quarter point camp. Bostic talking a little bit ago with reporters. He said some attenuation of inflation has happened, but there's still a long way to go. Households and companies he sees are still flush with cash. Big issue about how much that savings from the pandemic is still around. And then he says the fight against inflation is mathematically about halfway there. And just one or two more things here. He says the policy has only recently entered restrictive space. He expects it to start to bite in the spring. Good reason to think he believes that things will slow down in the economy comes the spring when the effects of Fed interest rates start to hit. Kelly.
All right, so this, Mark, kind of goes back to the discussion we're having. The Fed is data dependent. They're watching every single data point, and we're trying to make sure that these are reliable. One of the places where we're seeing more focus is on job openings, Mark. So, and we obviously on these programs talked to the ZipRecruiter CEO last week when the shares were down 25%. If you look at Indeed.com postings, those job openings are falling pretty sharply, while the Labor Department's data is holding up. Is that just a lag effect, or is there a data problem?
Well, there could be a data problem there, too. I mean, and the job openings has its own issues. I mean, I think what a lot of companies are doing, and now I'm speaking to you as a person who runs a business and hires lots of people, that, when you have normal turnover, people leave, that opens up the job position. And if you're nervous, cautious about the economy going forward, you say, okay, I'm just going to slow walk the hiring and just not fill those positions as quickly. I'm not going to get rid of the open position, and I'm not going to shut down the HR human resource activity because, restarting that is going to be very painful, very difficult to do. So I'm just going to slow walk things until those job opening positions start to rise. So it's not representing strength; it's representing actual weakness in the economy. So. And going back to Steve's point about the UI claims, Steve, you're right, but that's just a window on layoffs. I think most of the action, most of the slowing in the labor market, most of the weakening is with regard to hiring, what I just said. And there it's not only about imprecise data, it's just we don't really have good data to really see what's going on that side of the economy.
And Steve, I've heard